John, I'm going to give away a secret here. We're recording the intro after the podcast because somewhere in the middle of this, there's a break where the recording mysteriously stopped halfway through. So the challenge is to find it.
Yes, we will find it, and it'll sound like a great episode that's seamless because you're a great editor. We were right in this episode's going to be. We're right in beans. We're wrong in corn, but a little bit wrong in everything. You know, timing was everything. We'll go over where do we go from here, and we're already going to start talking about December 27 corn hedges. Not putting them on. What to do for next year. The whole cycle repeats. Again, we'll tackle 26. We got a lot of time to tackle that, but we're already looking forward to that. We're going to talk beans and weather.
Thanks, John.
Yes.
Welcome to Hedge Heads, where hosts John Prischmann and Ryan Tungseth discuss commodity markets, hedging, and anything related to trading futures. Remember, the risk of loss in trading commodity interests can be substantial. These are opinions only and not trading advice. While no one knows where the market's going, they're not afraid to share some ideas.
Well, John, I think what we learned is that corn leads oil, not oil leads corn. Huh?
Yeah, completely wrong on as long as the straits are closed, the grains are going to be supported here. Of course, we've been talking about the downside in beans for quite some time. Beans still are very capable of falling another $1. I mean, very capable. Not that I'm cheering for it, but where do we go from here? We touched on this a little bit last episode. Now the damage is done. What could have been done in corn? The incremental sales on the way up. Was there anything else? Guys shorting at the elevator or shorting here, and that was as good as it really got. Sure, you can short some calls. Guys shorted some calls. There was never any really great premium to get out, but of course, all that looks smart in hindsight. What's disheartening is this happened a full 3 weeks before normally seasonally it would happen, and this is going to be the third year in a row that we've fallen going into July expiration. I think it has a lot to do with the storage out in the countryside. So what happens is we're finding our bottoms in August, and that's the good news, and we'll get to that here pretty soon. It pushes down hard in August, and we've seen this for the last couple of years, makes a bottom, and then works its way out of there.
Do you mean June, not August?
No, I mean August as far as
August pricing.
August is when you'll find like new crop lows. You know, and sure. that's what we've seen for the last couple of years. So it pushes hard to these new lows, which we're in the process right now. Now, that being said, we have a lot of summer ahead of us. Rain for most everybody really has got this thing on its heels. That was selling out before the rain actually came. As a matter of fact, you go back a week and a half ago, it looked very dry for a lot of the U.S. Forecasts are shifting fast. Got very wet 2 weekends ago. Not this last weekend, the weekend before. Surprise rain for everybody that wasn't even in the forecast. And now everybody's getting steady with a lot more storms, especially to the north and the east of the growing belt. And that would be Wisconsin, Michigan, and a lot of storms coming that way.
Honestly, talk about perfect rain. It's been thunder and lightning, not stormy. Just some good thunder and lightning, rain overnight, and it's gone by morning.
Yeah, and then really warm temperatures has this stuff shooting up. Now, the crop conditions aren't as good as they were this time last year. Others argue. I saw Iowa was way better than. Way too early to tell anything. But with moisture coming, you have a complete pattern change that's been very dry in the West. We were as dry as we've seen it. Now we've got rain, and we're headed into the window. The window is June 18th, 19th into about the 4th of July, sometimes the 10th of July. You'll find you used to find your highs. Now the market is evolving, it seems like, unless there's going to be because there's no planting delays, or there hasn't been, and with the machinery that we have nowadays, the pattern we're seeing is this thing gets in a timely manner, and then we're seeing rain follow it, which is making the seasonal shorter and shorter every year. Last year it peaked out in February, and one could say really the seasonals are now the momentum. Guys chase momentum. It builds on itself. We've gotten to $5 3 times in a row now for corn, and that's all it's had. Now, where do we usually start? $4.60, $4.70. is where we start, and then we work up our way to $5. So we're talking like a 30-cent rally for the last 3 years is essentially what we've had to deal with. And it's very hard in marketing corn when you get a 30-cent rally. Now, do we say do nothing? No. Market incrementally. Are we where we want to be? No. And then I guess, a lot of people aren't going to be. But the good news is a lot of guys have marketed it. It's 40, 50, 60, 70% is very common. Where the last couple of years, it hasn't been that common. A lot of guys have moved most of their old crop. You're not hearing the same horror stories, but we are seeing the same patterns. This thing isn't holding together, and I think it has everything to do with commercial store or on-farm storage. It goes in the bin. So if it goes down to a low price in August, that's where we're finding our lows. We push the $3.95 in September, 2 years in a row, and then bounce quickly out of there. Ended, I think, 2 years ago at $4.30 at December expiration and $4.40 the year before. And now, without going too fast, what I'm trying to say is corn has not stayed below these levels or within 10 cents of these levels for very long. I mean, it has happened for the last 2 years, but it tends to come out of there because they need it. Demand is phenomenal. It's record-breaking. So you're seeing it get bid up shortly after the last of the old crop supply is used, which would be August, and then you're finding your bottoms naturally, and this cycle repeats. So that's what we would expect this year. But that being said, we still have a lot of weather. I mean, we definitely aren't anywhere near pollination or even close. But with this moisture now, we got a little buffer here, and that's really what we have going on in grains. We could talk about Iran, but that's
just a quick note, though. I mean, you talk about what you could have done, and correct me if I'm wrong. Weren't you mentioning a few weeks back that corn, when it was at, I want to say like 480, 490, we were looking at what the put was. And so I believe we were saying the net was like 460 or something.
It would have been like a $5 for 35 cents for 465 futures. So you bought a $5 put for 35 cents, it would be $5 minus the 35 cent you paid for the put on December. And then you would net out worst case scenario 465 futures. And then you have your upside wide open.
I'm just curious what that put was, and it'll take me a minute to find it.
Yeah,
what it's at now. But point being, like there were some options that you could do. Now, December corn's at 445 right now, so it is probably the line of profitability, and it's not a huge difference price wise.
Yeah, and then that's kind of what I was getting at. There isn't. It's been now in hindsight, there hasn't been any big slip ups in the last 3 years other than not marketing $5 corn. You haven't had to leave your upside open in the summer so far for 3 years in a row, which is very rare as well. You're just getting this good weather pattern, and it's continuing. This year, they sold it off extra early, well before weather, well before everything else, just because of what it looked like it was happening. And Iran was going to sign this deal. It's imminent and all this. And we're still hearing that to this day. The deal is right around the corner. Oil's cooled off a little bit, but it was still 95 when corn topped out. So, yes, to your point, it did not correlate at all to oil, which is a little different. One would not expect a complete corn breakdown with oil at $95, 92 call it, and we're going into one of the most volatile time periods of the year for weather premiums to go in the market, not out of the market, in the market. So it's never easy in marketing, and this certainly isn't easy. But the good news is we never were very high. We never rallied with oil much, 25 cents. And generally, the fall isn't too bad, to the lows. It can be, 20, 30 cents more than this. And then it comes rocketing back up here and gets to these prices. That's basically what we've seen. Is that a guarantee that's going to happen this year? No, but at least we have a template to work with.
Yeah.
We don't have the corn acres. That really bothers me, where the last 2 years, one expected the corn acres to continue to go up or at least be big. That's not expected this year. So it does bother me. We don't know that.
We'll see June 30th.
Yeah, that's going to be a huge thing. If we have, 2 million less acres, we have a subscription to crop profit, and, it's got the weather on it. And now I think their corn was the yield was climbing on it. I won't say the number because obviously you got to subscribe. So if we are above 183 and we have less acreage, it might cancel each other out. If we're a million less acres, just for easy math, and we're at 179, then we're going to come up from where we are right now in corn. But already on this dip, South Korea stepped in, and also Japan. People are interested in our corn. We're selling a record amount. The problem continues to be overproduction, and the whole market depends on the funds either buying it or selling it, which is not a great market. Not a great market to be in.
No.
So enough hemming and hawing about corn. I feel like we missed the chance at $5, and it's not coming back anytime soon. Where beans still could easily fall another $1 if the weather stays good.
Speaking of which, that $5 put is now 76 cents.
So at the cheapest, I think it was like 36, 37. I don't know that it ever got to the 35 cents I wanted. You could actually pull up a chart and see what the lowest price it was. So you said it was 75 cents and you paid 35. So you would have made 40 cents on that put. And that would, and then if you're able to take it off correctly and, that's the hard part of that.
It did get down to 36 and a half cents.
Yeah,
so
that's
close.
The best fill you could have got. Realistically, you're looking at 38, 39 cents. It never did cheapen up to where it made sense. Like, it's really hard to buy a 40-cent put, when the corn hasn't rallied very much.
Yep.
And that's really what it all amounts to. There was no great hedge. Sure, you could sold calls and bought puts, but that opens you to margin calls.
And it looked really risky at the time.
Exactly. So last year was hard in the fact that we had 1.2 billion bushel carryover, and then the wheels came off in February and never recovered. This year is hard we have the Iran war, so it's never easy in marketing. These markets still aren't easy. We have no idea what the rest of the summer weather is, and they already have it at a low price. So what do you do here? Sometimes there's just not a lot you can do. Again, we were marketing incrementally on the way up, or that was our recommendation. Hopefully, guys got enough on the books to make themselves comfortable, and then we'll start coming up with strategies to deal with getting rid of this new crop, which is going to become old crop pretty soon.
Do you just buy barbed wire and calves?
Yeah, that is the most efficient way to use the corn, and I would not be surprised if it starts trending that way. Granted, we're not going to grow the cattle herd, but you get tired of raising this corn and not getting paid for it. If you can figure out a way, and that's been the most efficient, is to feed it to cattle and sell cattle. Of course, that'll change as well, but that I don't doubt that some fence is actually going to go up. Guys get really tired of giving all this stuff away. It's really disheartening too, because we do have record demand. We're used to record demand and some sort of bullish markets, but look where these bull spreads are. Minus 18.5 for July, November beans. And then you look at July, December corn at minus 27. These are terrible numbers. I mean, these are numbers about as wide as it gets, meaning that even after this record demand, it's record crush demand in the U.S., and then it's record overall demand for corn, including exports. It's really disheartening when you have record demand or near record demand and then just simply can't hold even minor rallies.
Right.
Beans, I would argue that we had a very nice rally for the fundamentals, and it offered you all kinds of marketing opportunities. And I think we've said it enough that's what that market looked like it was.
My only problem with beans was the timing.
Yeah, I mean, it obviously fell a little bit early, but still, $12 for new crop all day long was available, and only recently did that disappear, and it's really not even that far away from it for beans. But really, we just keep overproducing, and we're getting little pitiful rallies. Wheat and beans. Wheat had a legitimate reason to rally this year. Beans had a Trump tweet that it really liked and rallied on that. So beans were a little bit of luck, and then corn rallied 25 cents from basically. So when I say 25 cents, I mean new crop corn gets to $4.75 every year, or it has in the recent past, right?
Yep.
So that's a common number that anybody could take, $4.60, $4.75, and then it barely rallies from there. That's what I'm saying. That's when I say 25-cent rally, I mean from where it normally is, midwinter going into spring, it's able to rally 25 cents. We used to have, dollar rallies. We're just not seeing that. It's not getting tight. The spreads are wide. We got rain in the forecast. We got a wet problem and overproduction, and that's what's going on in U.S. grains. And before I forget, I was going to bring up something interesting. I'm getting calls, And they're wondering if I think maybe they're listeners and they're talking to their banker and they're trying to come up with plans. I'm getting guys that want to do more on paper, and I tell you why. I think I figured this out. Paper, when I say paper, they want to do it here instead of commit the physical bushels to the elevator. For two reasons. A lot of elevators, and of course everyone's different, will charge anywhere from upwards of 3 cents or even more to roll contracts, to do various things. Of course, this is just a generic thing. So the costs are number one. Number two, they don't want to commit the bushels and get a better base and be able to pass on a better basis later on. So the basis is a big part of it. Of course, you don't have to lock basis with every contract, but I'm just talking about the ones where they do. They're finding that the basis is improving and they wish they would have waited. And they want more flexibility. That's what I keep getting for them. They don't want to be committed to these bushels at these prices. They want flexibility in their hedge. But that's a fine line too. You don't want to necessarily trade your hedge. You want to hedge the hedge. And I had a conversation with another producer about that. He wants to start hedging, doing it, hedging his bushels, and then when he sells his bushels, lifting the hedges. And I'm talking about hedging. And we've talked about, I have a couple guys that their mind's like a calculator, and that's what they do it. Other guys just want more flexibility. They want they want to be able to get out of these contracts when they want. Like, they see a low in August, they feel it's low enough, they want to be able to pull that. And, again, it gets expensive doing that stuff at the elevator. So I'm finding that interesting because the number of different people are calling, kind of all asking the same questions. And my advice is talk with your banker, get on the same page, come up with a plan. And there's nothing wrong with doing it in a brokerage account at all. It offers you that flexibility. Do 100% there? No. But start working that way if you want more flexibility. And the reason I want more flexibility, as I was saying, is that's where all the margin's been for profitability.
That's how tight margins are, right?
That's how tight margins are.
It's so tight that those 3 cents are really making a difference this year, which is tough.
So if you're doing it for less than a penny here, and you're able to do what you want, not commit the bushels. You have the banker covering your margin calls if you have it. And then you're rolling. Like we the guys that call us or talk to us, we'll tell them the optimal roll windows. We'll do more of that on the insider as well. So we try to get the rolls in the correct timing windows. And that's really where the profitability's been. It hasn't been in a higher price in corn now for years. And again, the same thing's happening. Beans finally got to a profitable price where you could just sell and be profitable. Where corn is just barely got there for the last 3 years. And then once that collapses, all the profitability has been in good rolls, better basis management, and storage, and then storing into a better market. That's where all the profitability has been. So that's why I think that there is going to be a move back to that as margins get thinner and thinner. Other guys stick with what they know, and it's a path of least resistance for them. Sure, I know it costs 3 cents, but the money's there, and I don't have to have margins and all that. A lot of people are getting away from that. Like I just mentioned, they're wanting to take control of their hedges. I think that's a good idea going forward. At least doing it on a smaller scale until you're comfortable with it. But because again, the margins are so thin, and that's what it is right now. That's the markets we have to deal with. But where do we go from here? Well, let's get back on the topic. Where do we go from here? We like the downside in beans as long as it's raining. I'm I'm doing it very cautiously. So currently we're looking for downside strategies in soybeans. That's number one. And what exactly are we doing? A lot of different things we're looking at, from bear spreads to selling a call, buying a put, to just buying puts, and what works for farms.
How about shorting 10 mini contracts?
10 mini contracts. Well, if you like to pay a lot of commissions, you sure can short 10 mini contracts. Do micros. They're even smaller. You can do that. Corn, if you want to press the downside in corn, like the last 2 years, like I mentioned, went to $3.95 by August. I don't think we've seen enough weather to get aggressive in anything. I hate to get too sidetracked. I want to see more weather. Granted, the weather forecast is bearish. And then we also have to see Iran and what's going on there. A Black Hawk helicopter got shot down last night. So far, it hasn't really intensified the fighting.
Oil's down to 88.
Oil's down to 88. And that's the markets we're given with. So, it looks like the war's flaring back up. But the trade is convinced this deal's right around the corner. They're certainly trading it. And, we still have that running in the background. We were totally wrong, or I was, in thinking that the grains were going to stick with their normal seasonal hang in here until they see a deal signed. But they didn't. You know what I mean? So this is what we have to deal with. Again, we're already looking at new crop 27 corn stuff, which, again, we'll talk about in the Insider on Thursday. And the whole cycle just repeats. It's just disappointing the way this all plays out year after year. We're just not getting any substantial rally in corn. Nothing really.
Right. Let's hit cattle quick, because that has been interesting. You want to talk cattle and flies?
Yeah, and then you have the screwworm and the flies.
Screwworm,
yep.
yeah.
And so what should a guy do? And that a lot of confusion in there more than ever. The board's not very good to hedge. What are we looking at? For a client, we were looking at, I think, 260 June 27 calls. 260 was a strike price. I think they were selling for like 240 something. They're looking for maybe not hedges in the hole, but is there anything I can do down here on cattle that I'm going to have ready to go for June 27? So selling a lot of time premium, is the only thing that I see. And of course, that's as risky as it gets. But how do you use a board that's $20 to $30 underpriced? And that's the problem for hedging. So as far as hedging goes, very difficult board to use. And we've been through a few of these cycles, and we talk about it. Doesn't mean that it can't keep going down at all. And that's what we've seen in cattle. Like, just when you think it's bottoming and it's way underpriced and it's going to go rocketing back up, screwworm or whatever, then it kind of fails. And we've seen this, so cattle look very different. What I think to happen to cattle and what I think is happening in the grains is a large amount of momentum traders flooded the markets, and they were also mixed with inflation buying on the oil. Now, it looks like they're throwing that trade away, and I think it includes some cattle. Of course, I can't know that, but that's what it looks like to me is happening, is that you're just getting this liquidation in this inflationary trade in commodities, which we talked about doesn't work. Just buying to buy for inflation ultimately pops. We had some July call puts on in beans, and it was one of those mean markets where it didn't fall when you wanted it to, and then when it finally fell, it's a little too late. And again, why do I hate July options? It seems to just fall short of the finish line for people. The guys that buy August were much happier in September than the guys that bought July. That being said, the July got to be profitable. But again, back to why I don't like July options. It just seems to be this in-between month. One of these years, what's going to happen, and it's not maybe going to happen this year, is that you're going to have an actual weather market. You're going to have things going on like we did for wheat this year. And it's going to go up substantially. Everybody's going to be so trained to be shorting these low prices, they're not going to recognize when that comes. Which
is funny, because 5 years ago, way pre-podcast, we were talking the other way.
Yeah. Yep.
Yep. I mean, it was after the great grain robbery, but
after the great grain robbery, we're going into that bear cycle where it wore everybody out going into the great grain robbery in 2019 into 20. It feels like we're going into that where guys are going to start letting this stuff go. And you know what? You have to. You can't store it indefinitely.
You have to you have to pay for stuff.
You have to pay for stuff. So it's just one of these markets where you're just trying to manage your expenses, come up with a good hedge plan with your banker, and then apply it. We didn't have a great hedge plan other than just selling on the way up. And I think that's where you got the best prices. I still like the upside wide open for this from these levels. We have not seen anywhere near enough weather to have any idea what yield's going to be. Nothing correlates to what's happening right now with final yield. So don't give up on this market either. Just take it day by day. That's all you really can do. There's no damage I feel is done mostly in corn. There might be another 30 cents. Other guys disagree. They're like, the next stop on the chart, it's 385. Could it go down to 385 and stay there? I guess if they don't want any acres next year, yes, it could.
It has.
Yeah, it has in the past. And if they're trying to get rid of corn acres, that would do it. So we're coming to a head. Either we're going to do what we've done the last couple of years, go down a little bit more, and then come straight back up to where we are right now, or we are going to go to a really low price to get rid of world acreage. I sure hope it isn't the low price.
Right.
Because it could be. But with record demand, I feel like it's going to be more like the last two years. And we still, again, don't even know, which is really unfortunate, that you have to make all your marketing decisions before you see any U.S. weather. I'm not a big fan of that, but, these are evolving markets, and a guy's going to have to evolve with them. I hope we can recognize some turning points coming up here. But I will already start my December 27 hedges that worked. The stuff that we did August last year worked wonderfully this year, and I'm going to do the exact same thing. So the whole cycle repeats. But again, we call us and we'll go over our short bean strategies, short bean ideas. We want to do it with limited risk. That's where I'm at right now. I don't know how you feel, but
I feel like we should cover that a little bit on the Insider on Thursday, but as much as we can on the recorded.
Yep. And it's just been really hard with this Iran and this oil. If you read enough, you're convinced that oil is going to $150, $200 a barrel, and you shouldn't be marketing anything. It didn't turn out that way. We're learning a lot about the Straits. We're learning a lot about oil reserves, and the oil analysts are still adamant. Numbers are numbers, and this thing is going. The wheels are going to come off, and we're going to $120 a barrel. And you know what? What if we do? What if corn goes to $550 again? That's the kind of markets we're dealing with. Wildly unpredictable. I don't think anybody has the answer. Just navigate it the best you can. Very, very difficult markets, and that fell very early this year.
What a great spot to end it, John. Why don't you leave your number for all the joyful news?
Yeah, well, no, we're ever looking forward. There is joyful news. We're working on better hedges, working with bankers, and just keep those legs moving. If you have any questions, especially the insiders that are subscribed, don't hesitate to call, and I'll go over everything in great detail, what we're looking at. You don't have to call and think like, oh, I need to have all this information ready. I'm going to be really nervous. These are all casual conversations.
And you don't have to do anything when you call.
No, just, I'll
except listen to John.
Yeah, you'll go over your numbers, and we'll talk about what guys are doing, if there's hedges we're missing. We just can't go over specifics on the podcast. We do that a little bit more in the Insider, and then, of course, the emails that go out. I just wish that we were more in sync with what's going to happen with Iran and a little more predictability. But other than that, you just keep those legs moving, and it will get better. But we haven't seen enough weather. Anything can happen. Give me a call at 218-731-1578.
Thanks, John.
Sure.
I think that was... Where are you going?
Oh, I forgot.